Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. And let's take a look at the midweek market update. Did not think I would be talking about bank failures today, but here we are. What feels like an intense amount of news Friday into Saturday into Sunday into Monday regarding SVB, the second largest bank failure ever. Just zooming out, looking at the number of bank failures post 2008, there have been failures. There haven't been many, and certainly not many of this magnitude. This is the first failure since 2020, late 2020. Silvergate, not on this list. They entered voluntary liquidation through the state of California. Signature is on this list, despite being seized, and that is a giant can of worms, another conversation entirely. But that is the second bank on this list. And at the end of the day, SVB got into trouble because it had a very concentrated depositor base who were all extremely sensitive to rate hikes. And, this is the big and, they did not have the deposits in cash to cover withdrawal demand. They loaded up on long duration treasuries, MBS, mortgage-backed securities, and were not hedged and rode it all the way down from the top. They were forced to take losses on extremely high duration underwater maturities and securities, and that's all she wrote. Now there are lots of comparisons and consternation to other banks, sort of in similar-ish but not really the same trouble, where yes, they have extreme held-to-maturity HTM losses, but they have either hedging effectiveness in place and or deposits to handle the withdrawal. The bigger issue is a general flee to the top five banks. I think it was Citi, JPM. One of those two was claiming that they basically have so many deposits, they're not even sure of the total yet, but it was something like 15 billion. For SVB, they had withdrawals last week totaling 42 billion, which they could not meet quick enough. And here's a snapshot. WAMU is the biggest bank failure ever. And the difference in the depositor base here, and this of course led to the government making a decision on whether or not to bail out the depositors, but not the bank, obviously. I don't think that was ever up for discussion. Bailing out the depositors is interesting because FDIC only covers 250,000. This shows you here that per account, most of the accounts, most of the money were not insured deposits. In fact, they were uninsured deposits. So there's a series of dominoes here. Really, SVB got so big because they were so good at customer service with VCs, with these startups, that most of these startups did all of their business with SVB, hence the large deposit sizes. So on Sunday night, I believe it was, the government released the BTFP program, Bank Term Funding Program, where they would basically buy assets at par in order to meet liquidity demands. Now, immediately, if you're a bank that is in trouble and doesn't have these assets that qualify for this program, you then are a market target. And that's certainly what we're seeing with First Republic Bank. And Signature kind of got snuck in here. There was certainly high speculation that Signature would be in trouble come Monday because of just the general concern following Silvergate and SVB. And it looks like it may have been targeted because of its involvement with digital asset companies. Barney Frank of Dodd-Frank fame is on the board there and has basically said, look, we thought we were solvent. We certainly looked like everything was okay. The U.S. government and the NYDFS claims that they did not submit the proper paperwork, or not exactly the terms they use there, but definitely an interesting and developing conversation considering crypto banks have been targeted ever since the FTX collapse. Certainly an interesting story here. Definitely recommend giving it a read. But on top of this SVB stuff, we of course had an interesting weekend in crypto because, oh, by the way, lots of crypto companies are startups. They're involved with Silicon Valley deeply. And one such company, Circle, held 3.3 billion in cash of its USDC reserves at Silicon Valley Bank. And so rightfully so, the stablecoin market value, this is super important, the stablecoin market value, not the peg. If you want to sell your USDC at 92 cents, no one's going to stop you. There's nobody on the other side of that trade other than the market. If the market believes that it should keep selling down, then so be it. This is a representation of buyers and sellers. And if the market thinks, for whatever reason, that a stablecoin should go below $1, then it does. And that's what happened. And it made sense because the reserves at that time were under the uninsured depositors bucket, the unsecured creditors bucket, and the government, US government, essentially bailed out USDC reserves by bailing out SVB depositors, and that's why you see this recovering into Monday. So right now we're slightly above $1 on USDC, but this illustrates for people exactly why total decentralization is important, right? There's nothing wrong against centralized stablecoins. They're super useful, but one of the pushbacks against digital assets is, well, just use a stablecoin. Well, here's why, right? You have to make sure that all the reserves at all times are liquid, held in responsible places, under responsible management, blah, blah, blah. And this is certainly an anomaly, but it's a very real risk. USDC has now said that a majority of their cash sits at BNY Mellon. But the market reacted probably how it should have, considering the news, because there was a potential run on USDC as these cash reserves dwindled if SVB didn't get bailed out. On top of that, Signet, also a big player in the Circle ecosystem for mints and burns. So it's just a giant, giant ball of yikes across the board based on entanglements, let's say, with a legacy banking system. And just having that amount of money, I don't blame Circle. They have X billion dollars. They have to figure out what to do with it, put it somewhere. And originally they had spread it across, I think, 5 or 6 banks, along with treasuries. They hold a mixed bag of stuff, but it's vulnerable. And we saw exactly what happened there. I mentioned FRC, and again, one of the reasons FRC is in trouble is because they don't really qualify for that BTFP program. And they are still, based on their stock price, in trouble-ish. And there's some uncertainty there. And we are also seeing uncertainty in Credit Suisse, which isn't really like Silicon Valley Bank, isn't like FRC, isn't like Silvergate or Signature. And this is probably the scariest part, is just the differentiating factors in all of these issues we're having with banking right now. Credit Suisse, a long time coming, crisis of confidence. I remember hearing about issues with them for months and months and months. Scandals and debt and regulation, just issue after issue. And we're seeing that in the stock price. And then today, sort of after hours, Swiss National Bank came out and said, look, we're going to backstop anything, whatever it takes, if need be. I think the Swiss are a little bit more socialistic in that regard than we are. So I don't think there was ever a question whether or not the Swiss National Bank would come in. But it appears as though it got bad enough that they had to say something. And throughout the day, there was this giant question of contagion globally. ECB also meets tomorrow. And the question is, how much are they going to raise? Are they going to do a 50, a 25? Are they going to stop? Europe is in a lot greater trouble on the inflation side of things than we are. So a giant, giant mess on our hands in the legacy side of things. And really, we're just seeing more and more consolidation towards the top 3, the top 5 banks, regional banks getting hit extremely hard across the board. And, we had CPI as well, which we thought would be the major story this week, but obviously not. CPI came in hot enough to where the question of whether or not the Fed needs to keep raising is a silly one. Of course, they need to keep raising by the looks of it, even with the lagging data. This is 3 times above the Fed's 2% target. Yes, we're headed in the right direction. Yes, we're still pointing down, but they have a long ways to go still. And it is of some relief that Truflation, which is a real-time measure of inflation, has come down quite a bit year over year. So we'll see if this pops up in next month's CPI print. I don't believe the Fed meets in April. So this Fed meeting coming up on the 22nd is a big meeting, because the question is, what does the Fed do here? The market really doesn't know what the Fed's going to do. These are meeting probabilities. Are they going to go 25? Are they going to go 50? Which was 100% on the table before SVB blew up. And now it's 0% on the table. Now it's, do we hold or do we raise 25? And again, no meeting in April. So the sensible thing to do is probably to continue raising 25. Similar with ECB, by not raising, you're kind of hinting that, yeah, there is a problem. You're kind of acknowledging maybe things are unraveling a little bit here. So this 22nd meeting, maybe the most watched and analyzed meeting in a very long time for the Fed. Not only are they not pricing in 100% hike, but they're also the market's pricing in cuts here way earlier than it was. If you remember last week, we were talking about cuts into 2024 into Bitcoin halving. Now we're talking about cuts as soon as June. So these banking headlines have certainly jostled the markets, but what has really done well and continues to do well, that you kind of have to remind people, especially those who don't understand the purpose of digital assets, as well. SVB might have collapsed. There might be issues with Credit Suisse, Silvergate, Signature, but Bitcoin continues to chug on. As we say, tick-tock, next block. It's doing what it's meant to do in a time when it's meant to do it, as banks are having trouble. Kind of why Bitcoin was created in the first place, born out of the 2008 financial crisis. This is a look at basically the number of pending transactions. So when we have events in the real world, let's say, this was kind of Terra blowing up, this was FTX blowing up, you see on-chain a flurry of activity. And in the recent case, we did see a flurry of activity, continue to see a flurry of activity on-chain. So that tells me these things happening in the real world definitely affect the digital side of things, because we're seeing a rise in utility. As one falls, another rises. Without issue, might I add. There weren't any hiccups here. We didn't require the Fed to intervene. This is completely outside of human control. Looking at the number of transactions on a weekly average, we're continuing to see a massive rise in transactions. Previously talking about this over the past year, it's basically been the same. It's been boilerplate. It's been okay. We're in this range. A bunch of these transactions are probably related to miners and not necessarily even, let's call them economic transactions. Whereas now, that is definitely not the case. We are seeing people using the chain to use the chain. We're seeing new addresses pop up. I'll show that in a second. But much like 2015 to 2016, where we basically held a range the entire time, we're seeing this bullish divergence between price and on-chain activity, because we continue to see a rise in on-chain activity where price has been relatively quiet. It's up 30% in 3 days on this banking news. And it's no surprise to me that we're seeing on-chain activity spike. That's what you should see. You should see utility spike when price spikes. Very often, those things do go hand in hand. As you see more demand for the chain, more demand for Bitcoin itself, price goes up. Looking at active addresses, less impressive, but there's certainly a rising trend here, let's say, since the bottom a few months ago. And really what I like to see is new addresses which continue to rise. Again, there's a bit of a bullish divergence here where price is essentially flat over the same time period. New addresses trending up quite nicely. Again, much like 2015, 2016, where pre-bull run of any sort or bullish rally, we are seeing just continued demand for on-chain activity. Wrapping up with some quick technicals, S&P's been all over the place. Legacy markets have been extremely volatile. This inverted head and shoulders dream gets canceled out anytime you break, in this case, the right shoulder to the downside. So there's been a lot of fear. The VIX is way up. Just some highly, highly unusual, unprecedented, government intervention on unsecured depositors. That doesn't happen every day, and you're seeing that in the market. And on top of that, this is the 2-year yield, which got crushed on this SVB news because it signals to the traders anyway that the Fed is essentially done or very, very close to done. Again, based on those probabilities, traders are pricing in a 25-point hike maybe, or the Fed just being done from here. I think a 25 is prudent. I think holding for 2 months is fine. Again, no meeting in April, but at this point, nobody thinks a 50 basis point hike, certainly the market. On the Bitcoin side of things, we did sell off initially on the SVB news. And like I said on Twitter, I certainly wasn't rushing to sell my Bitcoin. Certainly wasn't concerned where my Bitcoin was custodied. I had no issues with thinking about, man, I hope I don't have 250,000 in a bank account, because I certainly don't. For the crypto native people, we live on chain. So what do we care, right? Banks blowing up is in large part irrelevant to us if most of our wealth is stored on chain. So you saw a reaction to that news, and then you saw a reaction to the government stepping in and saying we're going to backstop these depositors and these banks. And on trend, we certainly look more bullish than we did in 2022. Still largely neutral, as crazy as that might sound. We're still within this $5,000 range between 20 and 25K. And as far as a trade setup or trade idea, this is a bit of a Frankenstein's monster, but it does meet the inverted head and shoulders criteria. You know, these don't always look perfect, just like the S&P, right? Really what you want to see is 3 clean lows with an extreme low in the middle, as well as ideally a clean horizontal, call it a neckline. So this does have a rather clean neckline. You know, the 3 lows, maybe 4 lows. We do see, you know, multi-headed head and shoulders, multi-shouldered head and shoulders. This is kind of all over the place, but from a technical perspective, I think it's safe to say that's on the table. And if you just measure that out, you get a range between 30 and 34. Basically, this is a weekly cloud level that's very important. A high time frame resistance level at around 32,000. Also confluence for resistance there. A large part of this bounce was based off of risk being back on the table if the Fed takes their foot off the gas on hiking. So it still comes down to what Jay has to say on the 22nd in regards to rates. ETH also bounced, but it's kind of in purgatory. ETH BTC falling off a little bit here, losing performance to BTC, and it's still in the range, right? This is a multi-month range, almost going on a year now. DeFi activity across the board has fallen off quite a bit, even though yes, there was a lot of trading in DeFi on this USDC dip below $1. But DeFi activity is down, NFT activity is down, you know, ICO activity is a thing of the past, obviously, but a lot of the utility across the board on ETH is down. And I think that's why we're seeing price just range extremely heavily here. I think after the Shanghai upgrade, which is when ETH unlocks for the staking component, are live, that will be better for ETH because you're completely liquid now on your staking. You don't have to rely on a derivative to sort of hedge anything, even though this headline says it was without issues. The issues, as far as I can tell, were minor, and it's still on schedule for sometime in April. And exchanges like Coinbase has already come out and said, look, we're going to process these unstaking requests in 24 hours after the upgrade completes. I think the bigger issue at this point isn't necessarily the code, it's regulatory risk, because the head of the SEC, Gary Gensler, continues to come out and say, look, proof of stake tokens are securities. Not might be, are. He's convinced that they are securities. Coinbase has said, look, staking isn't a security. We're going to defend that in court. So I think there's some regulatory clouding around ETH that may also be preventing price from doing slightly better than maybe it should be based on the fundamentals. So that's all I have for this one. Let me know what you think in the comments below. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and did not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.